Good morning, everyone. Thank you very much for joining us today for this webinar, Expanding to Spain, Corporate Opportunities and Tax Resident Consideration for UK Businesses. I can see that quite a few people are still joining, so let's wait a couple of minutes to give everyone the chance to join the session before we start. Please feel free to stay around. We will begin in 10 minutes. Okay, let's go ahead and begin. Good morning to all of you. On behalf of the Spanish Chamber of Commerce in the UK, I would like to give you a warm welcome to this morning webinar. Before we process, I would like to kindly remind you that this session is being recorded so that we can share it with you later. During the session, you can submit your question via the Q&A function, and they will be answered by our speakers following the presentation. Today, we will look at why Spain is becoming an attractive place for our UK businesses to grow, including opportunities in areas like the Canary Islands and what companies need to consider when expanding. We are joined today by two expert speakers, Natasha Meah and the CEO of EBF Consulting, and Coral Vázquez from PROEXCA. EBF Consulting is a bilingual advisory firm offering accounting, tax, legal, social security, and commercial law services. Founded in 1999, it has office in Lanzarote, Gran Canaria, and Madrid, and uses digital tools to support clients across Spain. With over 20 years of experience, it helps a UK and international companies navigate Spain's legal and tax system, providing clear, practical advice for business growth and expansion. Without further delay, I will hand over to Natasha.
Thank you, Maria, and good morning to everyone and welcome. Before I begin, I want to take a moment to express my sincere thanks to the Spanish Chamber of Commerce in the UK. The Chamber's team has been outstanding in their coordination and organisation of today's webinar. It's a genuine privilege to be speaking under their platform. I think their work in connecting UK and Spanish businesses creates real value for both economies, and today's a perfect example of that. I also want to warmly welcome our colleague from PROEXCA, the Canary Islands Agency for Economic Promotion, who's joining us today. PROEXCA plays a vital role in supporting foreign investment in the Canary Islands, and their presence alongside us this morning reflects exactly the kind of integrated, collaborative approach that makes international expansion successful. We look forward to their contribution later in this session. The webinar today is open to members and non-members of the Chamber alike, which tells me that the topic resonates widely, and it should, because what we're going to discuss this morning affects far more businesses than we realise. Lara? In the next 35 minutes, well, probably 20 minutes, 22 minutes, okay, before I pass over to Coral from PROEXCA, we're going to be covering 6 areas. First, we will set the scene by why Spain has become such a strategic destination for UK businesses post-Brexit. We will then look at the structural options available when entering the Spanish market and why the Canary Islands deserve particular attention. We will explore a trend that is increasingly common but poorly understood: company directors and shareholders personally relocating to Spain. And then this is where it gets a little bit more serious. We'll examine the corporate tax residency risks that arise when those directors continue to manage their UK companies from Spanish soil. We will also look at how and why the Spanish tax authorities have intensified their scrutiny since 2022. And we will close with practical recommendations for how to structure things correctly, protect your position, and take advantage of the genuine opportunities Spain and the Canary Islands offer. So let's begin. Let's start with a little bit of context. The relationship between UK business and Spain has always been significant, but since Brexit, it has taken on a new dimension entirely. UK foreign direct investment into Spain reached 5.8 billion in 2023 alone. There are now approximately 3,800 UK registered companies operating in Spain, and nearly half of UK firms have formally re-evaluated their European corporate structures since Brexit took full effect. Spain has emerged, perhaps more than any other EU member state, as the preferred destination for UK entrepreneurs and business owners looking to maintain their European footprint. The reasons for this go well beyond the geography. So why Spain specifically? What makes it the destination of choice? So from a commercial perspective, Spain offers something that no UK only structure can provide post-Brexit: direct access to the EU single market. For any company that services European clients, distributes goods into Europe, or simply needs an EU domiciled entity for contractual or regulatory purposes, Spain delivers that. Beyond market access, you have a highly educated, multilingual talent pool at internationally competitive salary levels, world-class logistics infrastructure through Barcelona and Valencia, strong legal certainty under an established civil law system that aligns fully with EU standards. And there is the personal dimension: quality of life, healthcare, education, climate. These are not incidental factors. For founders and directors making long-term decisions, they matter enormously. The combination of commercial logic and lifestyle appeal is powerful, and it explains why we are seeing such sustained migration of UK business activity towards Spain. When a UK business decides to enter Spain, there are broadly 4 structural approaches we see in practice. The first and most common for businesses seeking genuine European presence is establishing a Spanish subsidiary, a separate legal entity, limited liability, full EU legal standing. It takes longer to establish, but offers the clearest corporate separation. The second is an operational branch, an extension of the UK parent, faster to establish, but with implications for the parent company's liability and tax exposure. Third option, we see EU holding structures, particularly relevant for multi-entity groups looking to consolidate European investments efficiently and access treaty benefits. And then fourth, some businesses simply relocate specific functions, a sales operation, a finance team, into Spain without creating a full subsidiary. Each has its merits, but I want to flag something that applies to all of them, and that is the thread that runs through this entire presentation. Structure alone is not enough. Where a company is incorporated does not determine where it is taxed. What matters under Spanish law, under OECD principles, and increasingly under the tax agency enforcement, is where the company is actually managed. And this brings me to the Canary Islands. Before we move into the risk section, I do want to just take this opportunity because the Canary Islands represent some genuinely exceptional advantages. The Canary Islands benefit from what is known as the Régimen Económico Fiscal, which is the REF. This is a special economic and fiscal framework granted by the Spanish state, recognised and protected under EU state aid rules. It's not a loophole, it is legitimate, EU-approved framework designed to compensate for the island's geographic isolation and to stimulate international investment. Within that framework, the most significant instrument for international business is the ZEC, the Zona Especial Canaria. The companies admitted into the ZEC are subject to corporation tax at just 4% compared to the standard general rate of 25% on the mainland, although that has entered into a reduced amount, 23, 21%. But the general rate is at 25. In the Canary Islands, 4. In addition, there is the RIC, the Reserva para Inversiones en Canarias, which allows companies to set aside up to 90% of taxable profits into a tax-deductible reserve, provided those profits are reinvested in the islands. That means that the company ends up paying tax on 10% of profits that have been generated in that year. Then we've got VAT, which is known as IGIC. That runs at 7% in the Canary Islands compared to 21% on the mainland. For businesses that can genuinely establish operational substance in the Canary Islands, this is the key. The tax efficiency available is extraordinary and entirely lawful. Our colleagues in PROEXCA will be able to speak about this in a bit more depth when they take the floor. But I want you to hold this in mind as we move through the risk section, because the Canary Islands are not just a risk and mitigation story. They're a genuine opportunity story for businesses that approach them correctly. Now let's turn to what I think of as the human factor and the aspect that most people have not yet fully reckoned with. Alongside the corporate expansion we have been discussing, there is a parallel trend: the personal relocation of company directors, shareholders and founders to Spain. So the drivers are straightforward: climate, lifestyle. Spain consistently tops the rankings for quality of life among British expats. Education, international schools, bilingual programs, EU university access for children, the appeal of EU residency rights, whether through the digital nomad visa, the non-lucrative visa or the golden visa route. And then there's Law Beckham, formerly the Régimen Especial para Trabajadores Desplazados, which allows qualifying new residents to pay a flat rate of 24% on their Spanish source income for up to 6 years. That is a significant personal tax advantage for high earners. And then post-pandemic, remote working has made it all more viable than ever. A director can now manage a UK company from a villa in Gran Canaria or an apartment in Madrid with minimal visible disruption to the business. And this is where the problem has been arising. While the personal relocation appears seamless from a corporate tax perspective, it is anything but. On this slide, we've tried to capture very directly the central disconnection that we encounter almost every week in practice. On the left, you have what directors typically believe. The company is incorporated in the UK, the bank accounts are there, the client's contract with the UK entity, the registered office is there, and therefore, hey, I'm fine. But then on the right, you have what the Spanish tax authorities, the AAT, may actually be looking at. The director lives in Spain full-time. Strategic decisions are being made from Spain. Contracts are negotiated from Spain. Staff are directed from Spain. Banking is accessed from Spain. The critical point here, and the one that I urge you to take away from this webinar today above all else, is this: incorporation is not the same as tax residency. The place where a company is registered and the place where it is taxed can be very different things. And increasingly, the tax authorities in Spain is exploiting that gap. Let me now introduce the legal concept at the heart of all of this, okay, which is the place of effective management, commonly referred to as POEM. Under the OECD model tax convention, which underpins double tax treaty network, including the UK-Spain treaty, and under Spanish corporate tax law, Article 8, a company is tax resident where its effective management and control is exercised, not where it is just incorporated, not where its registered office is, where it is actually managed. So the question the tax authorities in Spain ask is simple. Where are the people who make the key strategic and commercial decisions, and where do they make them from? They look at 6 factors. Where do the directors physically reside? Where are the contracts negotiated and signed? Where are financial decisions and banking authorizations made? Where are staff and suppliers managed from? Where do board meetings take place? And where is the company's strategic plan formulated? If the honest answers to most of these questions point to Spain, and for many UK incorporate businesses managed by Spain-based directors, they do, then Spain may well have a legitimate claim to tax the company's worldwide profits. This is not a theoretical concern, it's an active enforcement priority. The POEM concept, it's not new. What is new is the enforcement environment. 3 things converged to create the current situation. First, the pandemic normalized remote management. Millions of business decisions began being made from home offices, kitchen tables, and second properties in Spain. The corporate world adapted rapidly. The tax world took note. Second, Brexit triggered a wave of UK director relocations to Spain. Many of those individuals brought their UK companies with them, structurally unchanged. And then third, from 2022 onwards, the tax authorities in Spain significantly intensified its review of foreign incorporate companies where directors are resident in Spain, combined with enhanced EU-UK information exchange under the DAC 6 and international banking transparency frameworks. The tax authorities now has considerably more visibility into cross-border structures than it did even 5 years ago. So by 2024, what we're seeing now are the first waves of formal challenge letters arriving at UK incorporated entities, which shows that this is no longer on the horizon, it's actually here. So what does the tax authorities actually look for when assessing whether a UK company is effectively managed from Spain? The 4 high-risk indicators are things that most directors with a genuine life in Spain will have without thinking twice about it. Registration on the municipal census, the padrón, accessing the company's UK bank accounts from Spanish devices or IP addresses, Spanish mobile contracts and internet connection, paying autónomo contributions or having Spanish-based employees. Each of these individually might not be determinative, but together they do build a picture, and the tax authorities is very good at building pictures. The moderate risk indicators, property ownership and children in Spanish schools, do add further evidence of permanent establishment in Spain that reinforces the primary case. So the message I would like to leave with you on this slide is not one of alarm, it is just simply one of awareness. If you or your clients are in a position, the question is not whether the tax authorities might look, it's whether you are prepared for perhaps when they do. Let me direct about what is at stake if a POM challenge succeeds. The company's worldwide income becomes subject to Spanish corporate tax at 25%, not just on Spanish source profits, but on global profits. Simultaneously, the UK will continue to assert its own tax residency, creating a dual residency conflict that requires resolution under the UK-Spain double taxation treaty, a process that can be really lengthy and expensive. Beyond the headline tax exposure, there are transfer pricing reviews on any intragroup transactions, potential permanent establishment assessments, even where full residency is not established, and significant compliance and governance restructuring costs. So perhaps most seriously, retrospective assessment. If the tax authorities concludes that effective management has been exercised from Spain for several years, they can go back, typically 4 years, and longer in cases involving fraud or concealment. That means historic profits that the director believes were fully UK taxed may face a second charge in Spain. So this is why proactive planning matters so much more than a reactive compliance. The reason why so many UK businesses find themselves in this position is that they approach Spain in pieces. The corporate structure was handled by one advisor, the personal tax by another, the operational setup by someone else, and no one really looked at how all the elements interact. Integrated planning means bringing together 5 things simultaneously: the business structure, the director's personal residence position, the governance framework, the operational substance of the entity, the jurisdictional incentives available, whether on the mainland or in the Canary Islands. So address all 5 together and you may have a structure that is resilient, efficient and defensible. But if you address them in isolation, then you may find that solving one problem actually creates another. So what should you actually do? Let me give you 6 concrete recommendations. First, conduct a POM audit before or immediately after relocating to Spain. Take stock of where your company's effective management is genuinely being exercised. Document everything, where board meetings are held, where decisions are made, where contracts are signed. Second, establish robust governance protocols. Hold formal meetings in the UK, minute them properly. Where possible, ensure that genuinely independent UK-based directors are involved in key strategic decisions. Governance documentation is your first line of defence. Third, review your director service agreements. They should actually reflect the reality of where duties are being performed and how time is allocated between jurisdictions. Fourth, evaluate your personal tax position in parallel. The Beckham Law, your treaty position, your days spent in each country, these need to be assessed alongside the corporate structure, not after it. And then fifth, if you have genuine operational activity that can be established in the Canary Islands, explore the SEC and RIC framework seriously. The tax efficiency on offer is substantial and entirely EU compliant. So, as I mentioned, our colleagues in PROEXCA can advise on the operational investment support available to businesses, if they want to consider that route later. And then 6, seek genuinely integrated advice. Find advisors who understand both UK and Spanish tax law and who will look at your full picture. Fragmented advice leads to fragmented and vulnerable structures. So to close, I want to bring this back to the central message of today's session. Spain and the Canary Islands in particular represents a genuine and compelling opportunity for UK businesses seeking to grow their European presence. The structural frameworks are well established. The tax incentives were properly accessed are significant. The lifestyle and talent advantages are real. But opportunity and risk, unfortunately, do travel together. The same factors that make Spain attractive for personal relocation, the ability to live and work there seamlessly, are precisely the factors that create tax residency exposure for the companies those individuals continue to manage. So understanding that interaction, planning for it proactively, and structuring correctly from the outset, that is how you capture the opportunity without inheriting the risk. At EBF Consulting, this is what we do. If anything I've shared today resonates with you, your own situation, or with a client situation, then I would, encourage you to get in touch. And the earlier we can look at the structure, the more options are available. We're happy to collaborate and help anybody that needs it. So now I will pass over to PROEXCA. Coral, after her intervention, will be available for any questions that you may have. So thank you very much. I'll hand over to you, Coral.
Hi, thanks, Natasha. Good morning, everyone. I'm Coral. I'm the person responsible for the audiovisual and digital industries at Invest in the Canary Islands in PROEXCA. So thank you all for being here, and to the Spanish Chamber of Commerce for the invitation and the coordination of the webinar. And thank you, Natasha, for that great overview of the key legal considerations when expanding to Spain, and as well as the tax advantages available in the Canary Islands. So what I'd like to do now is focus specifically on what really differentiates the Canary Islands. As Natasha mentioned, the tax incentives are very attractive, but what truly makes the region unique is its overall value proposition. So not just the tax benefits, but the complete business environment that it offers. Today, the islands host over 900 special companies at the Canary Islands Special Zone. So this is a sign of the growing confidence in a region. And in the next minutes, I will explain why more companies are choosing the Canary Islands to scale and to have long-term operations there. So first, I want to give you some context in case you are not very familiar with our region. So the islands have a population of over 2 million people and a significant expat community. And also, well, we're one of the leading tourism destinations in Europe. So this makes us a very dynamic market. And also, we are very well connected with over 150 direct flight destinations. So we are not looking at a remote tourism location, but we're looking at a very well connected and growing local market. So next, please. And well, even though the Canary Islands are best known as a tourism destination, today we have a much more diversified economy, driven in part by the attractive tax incentives that we have in the last years. So leading the way of these new industries and sectors that we have in the islands is the audiovisual industry, which has grown exponentially in the last 10 years. And we also have strong technological and innovative industries, such as the microchips, software development, and aerospace, for example. And because of the particular characteristics of the region, we also have a strong blue economy industry and R&D as well. So next. So this is a combination of the factors, which I will explain down, that have driven this diversification. So as you can see, it's not only taxes, but a set of different elements that has really driven the growth and the diversification of the islands. So next, please. So first of all, apart from tourism, the Canary Islands offer really a strong business environment. And this is built through, or this was built through close collaboration between the public and the private sectors. So in the islands, you'll find, for example, a growing startup scene with over 1,000 companies. You'll find technology parks, innovation hubs, universities, and research centers, and active investor networks and funding options. But what really makes the difference of the region is a level of institutional support. As Natasha was mentioning, companies are not left on their own, but they are actively supported from the moment they land in the islands. And at PROEXCA, for example, we help companies with soft landing, with talent connections, with strategic advice, and with ongoing support as they grow and as they want to internationalize to other regions. So we act as a partner that help the companies like through every step of the way. Talent is also always a key question when it comes to companies setting up in the islands, and especially for innovative and technological companies. And even though finding specialized talent it's hard to find anywhere in the world, in the Canary Islands we do have a strong access to a pool of talent, and this is because we have 2 public universities and 3 private ones, so 5 in total. With more than 40,000 students that enroll each year, around 8,000 of them come from science and engineering fields. And there is also government support available for tailor-made training programs when the companies require specific profiles, so we can always make that work. And additional to those numbers of talent, we also have low turnover in the islands, a lower turnover than in mainland Spain. So companies can benefit from stable and long-term teams. And also, people want to come and live in the Canary Islands. So that makes it makes it easier for us to attract both local and international talent. And in fact, most companies that set up a presence here, they end up hiring both local talent, but also they attract international talent from abroad. So it's a mix of both kind of people when they set up a company here. Then when it comes to the tax environment, Natasha has also already explained a bit, and I don't want to repeat too much, but I want to highlight that these incentives are fully aligned with the European Union regulations. They are anchored in the Spanish legal system and then provide long-term legal certainty. So it's not that it comes and goes, but they are permanent and long time. So this provide a stable and a reliable tax framework for companies. So if you, when we finish, if you have any more questions on the tax incentives, we can also go through it. And the next, please. Another key point of the islands, I already have mentioned some of it, is the connectivity. So the Canary Island offers in one side, excellent digital connectivity and high-speed broadband because we have the submarine underwater cables that run through the islands and then link us to Europe, Africa, and America. So the digital connection is really fast and low latency. And we're also connected through the flights. So we have direct flights to all major and medium-sized European cities, and of course, including London. And we also have the same time zone as the UK. So these set of connections mean you can work very smoothly with your teams and clients from the islands. Next. And then last but not least is the quality of life that we offer. This maybe could be underestimated, but it's actually a key driver for companies. Companies that establish here often tells us this is the main reason that they choose to stay. As you may already know, we have year-round mild climate and sunshine. We have high-quality healthcare and international schools for the families of the talent that come from abroad. We have a lower cost of living than most of the European cities. And all these factors have a direct impact on the talent attraction, on employee satisfaction, and on the overall productivity of the companies. So in other words, this helps build happier and more stable teams, which is very important nowadays, and especially in the innovative and the creative industries, for example. And well, then, so only to conclude and to wrap it up, the Canary Islands are not only about tax advantages, but we offer the whole package. So for companies looking to expand to Europe, we offer a strong business ecosystem, access to talent, excellent connectivity, a high quality of life, and a very attractive tax framework to close it off. Here, well, we just can take a quick look at some success stories. You can see that all huge audiovisual companies already have a presence in the island, and also we have some examples of industrial companies and of digital and technological companies. So we have a wide variety of success stories. And this is all from me, and I'm here if you have any questions or comments. So thank you.
Thank you very much, Natasha and Coral, for sharing your knowledge. We will now open the floor for questions. I have some questions. The first, can a UK benefit from the Canary Islands especially zones, or does it need to be a Spanish entity?
It needs to be a Spanish entity. So what you would need to do there is incorporate a Spanish entity over here as an entity in its own right. The UK company on its own cannot directly access SEC benefits. However, a UK group can establish a Spanish subsidiary in the Canary Islands, and then it would be the Spanish subsidiary that qualifies for the SEC. And that subsidiary would then carry out the relevant business activities on the Canary Islands and apply the 4% corporation tax rate. So that the group structure needs to be carefully designed to ensure that the transfer pricing and substance requirements are met. But it's absolutely achievable, and it's something that many UK-based groups have begun to do. The key is planning the structure correctly from the outset rather than trying to retrofit it later, but it's a simple one to do. So yeah, it does need to be a Spanish entity.
And I will also like to add something, Natasha, here.
Yep.
Is that the basic requirements to be a SEC company is investing 100,000 euros and creating 5 jobs and having an administrator here in the islands. So yes, the idea is to have real activity here in the islands, to be in the Canary Islands special zone.
Mm-hmm. I just want to add, we're going to be adding one another here, but we're bouncing off one another. What you've just said there is great. The islands will be Gran Canaria and Tenerife to comply with those limits that Coral has just stated. But on the other islands, we're 8 islands in the Canary Islands. Okay, the 8th one is La Graciosa, but it's very, very small. It's on the north of Lanzarote. But all the other islands, it's actually 50,000 euros in the first 2 years of establishing the company, and it's a creation of 3 jobs, right?
Exactly.
So
that's right.
Yeah, I think that's also important to mention. I know the question hasn't been there, but I'm just bouncing off what you've just said. And please also remember that the jobs that you have to create are full-time jobs with their own job description. When we do the plan, we get involved in the business plan that's required to be able to obtain the SEC authorization for that Spanish entity that you want to create. We do have to clearly state out what those jobs are, okay? And those jobs cannot be occupied by the administrator or the shareholders of the company, nor can they be occupied by the family or relations to the shareholders or the administrator of the company. Okay, so I think that's important to take in mind as well. That's generally, the common questions that are asked when we talk about a SEC.
All right, thank you. Another question. If I'm already living in Spain and manage a UK company from here, what should I do right now?
Then you really need to get some honest assessment on your position. A genuinely honest assessment, and you need, if you've already got an advisor, then you need to make sure that they're aware of, what the situation is at your advisor in the UK, your advisor in Spain, and decide where are you really making your decisions, where are you accessing the company's banking, where are the contracts being negotiated and signed. If the answers point predominantly to Spain, then you really need to take action before the tax authorities come to you rather than later. Some of the main concerns are when you've got two a married couple with a company in the UK, and they're the only people that are actually physically carrying out the activity of the company. There's no employees, there's no real office. That they're based in Spain or in the Canary Islands, so that they're actually in effect trading from the Canary Islands. That's where all their source of income's coming from. So that's a very vulnerable situation to be in. But there might be other scenarios that may be well worth looking into if anybody finds themselves, or whoever's asked the question finds themselves in that position. Look at that. Where are your formal board meetings? Make sure you've got all evidence for UK-based decision making. And seek advice on that, because every situation is different and every situation needs to be looked at individually. But I would definitely urge that person to not just do nothing, definitely look into it and look over the past 4 years, just to make sure everything's correct.
All right. Next question. Can the tax authority really look back several years and charge the tax retrospectively?
In Spain, it's 4 years. And they will go back the 4 years. But if there's any cases of evidence of fraudulent concealment or deliberate non-declaration, then that window can extend to 10 years. Okay. And that's obviously an important factor to take into consideration as well.
All right. And the next question. How long does it take to set up a SEC company in Spain?
Right, okay. To set up a SEC company, it's slightly longer than a standard Spanish company, because there's an additional process that needs to take place. The SEC has its own consortium, it has its own registry. So so you would end up with a normal Spanish company. Your entity in itself would be that, but it does have to have a specific authorization from the SEC consortium, and it has to be registered in their registry as well, where they can ensure that the activity that's being carried out complies with the activities that are permitted within the SEC zone. Okay, so not everybody, bar, restaurant, isn't an activity that's permitted in the SEC zone. It's very technological. Consultancy, accounting, they are also available. Wellness centres, for example, they seem to be quite popular at the moment. Wellness centres on different islands, so they form a group there which works quite well. So setting up the SEC entity could take, I would normally say, between 2 to 3 months, simply because first we have to do the business plan. The business plan, that's working with the client and making sure that everything complies with what it's supposed to comply with. That's then presented to the consortium council. They have 1 or 2 meetings a month. So once they've approved it, we can then move forward. But in the interim period, that company is not permitted to actually carry out any activity whatsoever. This has to be a new activity. So it can take its time a little bit more to get it done properly. I would always recommend that we have a 2 to 3 month planning time to structure it with the client.
All right. Do we have more questions? Please feel free to participate and raise any question you might have. If you would like to open the camera, please don't be shy.
No.
Don't be shy. They can answer your question. It's not a silly question.
Well, I hope everything's gone well, and I hope people have found the information helpful. This is just to make sure that they're aware of what is happening in Spain at the moment. It's very new, so we will need to make sure that people are being represented properly, that the allegations are well prepared, so that they've got the best defence possible. And then we'll need to see over these next years. We have case law in Spain to see what the Supreme Courts make of this scenario that some clients from 2024 are finding themselves in. So we just wanted to raise a little bit of awareness and make sure that they know that, if anybody's got clients in that situation, or they need to collaborate, or anybody themselves are in that position, then, we're here to help. And PROEXCA, for anybody that wants to invest newly, fantastic onboarding plan. So, they can be well looked after.
Perfect. I can see there's one question. Yes, we will send you emails with the slides and with all the details, with the emails with the Natasha and Coral, with the webinar, in case if you would like to see it again. So let's bring the webinar to the end. Thank you again to our speakers today for the session, and thank you all for joining us. And we hope you found it useful and interesting. As I was saying, later today, you will receive an email with the recording for this webinar. And if you have any further question, please feel free to contact the speakers directly. They will be happy to help you. From our side, I would like to remind you that we are hosting an event next Wednesday, the third Premio PYME Santander, taking place at the Spanish Embassy. It recognizes the SME Cross-Border Board. And also, I would like to invite our members to our 5th edition of our annual business cocktail in Madrid. This event brings together senior leaders from business, industry, and institutions across the Spanish and British community. It is a space where attendees can connect, build relations, and discuss the involving links between both countries. You can read more about these events and sign up to our website or via our social media channels. Thank you so much and have a nice day.
Thank you.
Thank you.
Thanks.
Thank you.